Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are plowing straight into one of the most iconic American companies ever built. We're talking about the green and yellow giant, Deere Company, ticker DE.
And I'm Lana Chen. Hudson, this is a company that's been around since 1837. That's almost 190 years of making things that move dirt and harvest crops. But what makes Deere fascinating right now is that they're not just selling tractors anymore. They're building an agricultural technology empire.
Exactly. And the timing is incredible because CEO John May has gone on record saying 2026 is the bottom of the agricultural equipment cycle. If he's right, this could be the setup of the decade for Deere investors. But there's a lot of nuance here. Tariff headwinds, margin pressure, and a valuation that's running hot. Lana, let's dig in.
Let's start with what Deere actually does, because it's broader than most people realize.
Right. So Deere operates through four main segments. First and biggest is production and precision agriculture. Think massive combines, large tractors, sprayers, the heavy iron that runs commercial farming operations. Then you've got small agriculture and turf, which covers utility tractors, riding mowers, and golf course equipment. Third is construction and forestry, excavators, dozers, loaders. And finally, financial services, which provides equipment financing and crop insurance.
And here's the scale we're talking about. Deere generated $45.7 billion in revenue in fiscal year 2025, employs roughly 83,000 people, and serves customers across more than 160 countries through a dealer network of over 1,900 locations in North America alone.
Headquartered in Moline, Illinois, about as heartland America as it gets. And that dealer network is genuinely a competitive moat we'll come back to. But first, let's talk about the man steering the tractor, CEO John May.
May has been CEO since November 2019 and chairman since May 2020. He joined Deere back in 1997 after consulting at KPMG. He's held just about every major role, ran the China operations, served as chief information officer, led the entire worldwide agriculture and turf division. He's a lifer who understands every gear in this machine.
And what's made his tenure stand out is the technology pivot. Under May, Deere has been transforming from a pure equipment manufacturer into what's essentially a precision agriculture technology company. His target? Get 10% of total revenue from recurring software subscriptions by 2030. That would fundamentally change how Wall Street values this business.
It's a bold bet, and it's working. Their See & Spray technology, which uses AI-powered cameras mounted on booms to identify weeds in real time and spray only where needed, covered 5 million acres in 2025. That cuts herbicide use by roughly 50% per acre. For farmers, that's real money saved.
And for Deere, that's a customer who's now locked into their data ecosystem. Years of field data, route optimization, agronomic records, all inside the JD-Link platform and John Deere Operations Center. Switching to ATCO or CNH means walking away from all of that. Classic switching costs.
All right, Hudson. Let's get into the numbers, and there's a lot to unpack here because Deere is in an interesting financial moment.
The floor is yours, Lana.
Starting with valuation, Deere is currently trading around $581 per share, giving it a market cap of roughly $161 billion. The trailing PE ratio sits at 34.5 times earnings with a forward PE of 33 times. Price to sales is 3.52, and EV/EBITDA comes in at 20.5 times. The PEG ratio is 1.6.
And for context, Deere's 10-year median PE is around 19 times. So at 34.5, we're trading at an 82% premium to the historical average. That's a lot of future growth already priced in.
It is, and the market is clearly pricing in the cycle recovery thesis. Moving to income and growth. Fiscal year 2025 revenue was $45.7 billion, which was actually a 12% decline from fiscal 2024. That's the agricultural downturn showing up in the numbers.
But the story changed in the most recent quarter, right?
It did. Q1 fiscal 2026, reported February 19th, came in at $9.61 billion in revenue, up 13% year over year. That beat analyst estimates of $8.8 billion. Earnings per share came in at $2.42 versus the $2.02 estimate, a solid beat on both lines.
So the top line is recovering. What about profitability?
This is where it gets complicated. Despite that 13% revenue growth, net income actually fell 25% year over year to $656 million. Gross margin is healthy at 38.4%, but operating margin is running at about 16.5%, and net margin is 11.3%. The culprits are tariff costs, projected at $1.2 billion for fiscal 2026, warranty expenses, and an unfavorable product mix shifting towards smaller, lower-margin equipment.
So revenue is growing, but profits are shrinking. That's the tension at the heart of this story right now.
Exactly. Now, on cash flow, operating cash flow for fiscal 2025 was $7.5 billion, down 19% from fiscal 2024. Free cash flow came in around $5.5 billion, with capital expenditures of $4.2 billion. The FCF yield is about 3.4%.
How's the balance sheet looking?
The balance sheet requires context. Total debt is $64.2 billion against total assets of $106 billion. Debt to equity is 2.46 times, which sounds alarming until you realize that the financial services segment, which provides equipment loans and leases, drives most of that leverage. It's structural to their business model, not a sign of financial distress. Cash on hand is $6.9 billion, and the current ratio is a comfortable 2.22.
So the headline debt number is scary, but the underlying liquidity is actually solid.
Correct. And on dividends, Deere pays $6.48 annually, yielding 1.11%. The payout ratio is 34.2%, which gives them plenty of headroom. They've paid consecutive dividends for 53 straight years. The 5-year dividend growth CAGR is 12.5%. This is a dependable income stream.
53 years. That's impressive commitment.
Overall, Deere's financial health is watchful. The revenue recovery is encouraging, and the balance sheet is structurally sound. But the disconnect between top-line growth and bottom-line compression from tariffs and margin pressure means investors need to watch whether profitability catches up as the cycle turns.
Great breakdown. Now let's talk about what the street thinks. Analyst consensus on Deere is a moderate buy, with 22 analysts covering the stock. That breaks down to 9 buys, 5 holds, and 1 sell. The median 12-month price target is $618, which implies about 6.4% upside from current levels.
The range is wide, though. The low target is $514, and the high is $793, courtesy of Truist Securities back in February. That Truist call is interesting because they're pricing in full cycle recovery plus the precision ag transformation premium.
On the other end, JP Morgan's Tammy Zakaria has a neutral rating with a $550 target. She's more cautious on the near-term ag cycle uncertainty. So you've got a nearly $300 spread between the bulls and the bears on Wall Street.
On insider activity, CEO John May sold 41,472 shares on January 8th for about $20.8 million. But this was tied to a concurrent option exercise at $254 per share, so the net proceeds were closer to $10.2 million. It looks like standard plan diversification rather than a directional signal.
Congressional trading filings show 6 trades in the past 6 months, 5 sells and 1 buy. Insiders are broadly net sellers, which is worth noting, but not necessarily alarming given the stock's run-up.
And in the options market, the put-call ratio is 1.08, slightly above 1, which leans bearish. Recent unusual activity shows 8 large put trades totaling about $904,000 in notional value versus just 4 call trades at $235,000. The smart money appears to be hedging more than speculating on upside.
All right, let's lay out the bull and bear cases. I'll take the bull side first. The biggest catalyst is the cycle recovery. John May has called 2026 the bottom. If large ag equipment demand snaps back in 2027, Deere is positioned to ride that wave with massive operating leverage. They've already raised full-year guidance to $4.5 to $5 billion in net income.
And the precision agriculture flywheel is real. See and Spray covered 5 million acres in 2025, and model year 2027 expands it to wheat, canola, barley, and peanuts. Each acre that comes onto the platform deepens the data moat and generates recurring revenue potential.
The construction and forestry segment is already surging, up 15% year over year, benefiting from infrastructure spending under the IA. Small ag and turf is also growing 15%. So it's not like the entire company is in a downturn. 2 out of 3 equipment segments are growing nicely.
And the long-term vision of 10% recurring software revenue by 2030 would structurally re-rate the stock. Wall Street pays higher multiples for recurring revenue streams, and if Deere executes on that, the current premium valuation could be justified.
Now the bear case, Lana?
The biggest risk is that the cycle doesn't recover on schedule. Large ag demand is still weak. Production and precision ag sales are guided down 5 to 10% for fiscal 2026. If 2027 doesn't deliver the rebound, the current valuation becomes very difficult to defend.
And the tariff headwind is real, $1.2 billion in fiscal 2026. If trade policy escalates further, that number could grow.
The valuation itself is a risk. At 34.5 times earnings, 82% above the 10-year median, there's very little margin of safety. If earnings disappoint or the recovery is delayed, the stock could see significant multiple compression.
And that Q1 dynamic, revenue up 13% but net income down 25%, is concerning. If profitability doesn't improve alongside the revenue recovery, investors are paying a premium for growth that isn't flowing to the bottom line.
The leverage is worth watching too. $64 billion in total debt is structural to the financing business, but in a rising rate environment, the cost of funding that portfolio matters.
Fair points all around. Let's do the peer comparison. We're looking at Deere against Caterpillar, AGCO, and CNH Industrial.
Caterpillar is the largest in this group at a $370 billion market cap and trades at 38.1 times earnings. But CAT has been on a tear, up over 100% in the last year, driven by AI data center power demand and a record $51 billion backlog. Revenue growth is 4.3%, with operating margins of 17.4%.
So CAT is actually more expensive than Deere on a PE basis, but it's benefiting from a completely different demand cycle: data center infrastructure versus agriculture.
AGCO is on the opposite end, market cap of just $8 billion, trading at only 13.9 times earnings. But revenue growth is slightly negative, and operating margins are around 7.8%. AGCO has the Fendt brand and some interesting precision ag tools, but they lack Deere's scale and dealer network depth.
And CNH Industrial.
CNH trades at 19.9 times earnings with a $13 billion market cap. Revenue declined 9% in fiscal 2025, and they've guided for ag equipment sales down 13 to 18% in 2026. They're the cheapest of the group on valuation, but they're also facing the steepest headwinds.
So Deere sits in the middle, more expensive than AGCO and CNH, cheaper than CAT, but arguably the best position for the technology transformation that could justify a premium multiple.
That's a fair summary. Deere has the strongest moat, the deepest tech stack, and the most credible path to recurring revenue among the pure agricultural equipment players.
All right, bottom line. Deere is a 189-year-old company that's reinventing itself as a technology platform at the exact moment its core market is bottoming out. If the ag cycle turns in 2027 and the precision ag flywheel keeps spinning, this could be a compelling long-term hold. But at 34.5 times earnings with $1.2 billion in tariff headwinds and declining near-term profits, the entry point matters.
The single most important number to watch is the production and precision agriculture operating margin. In Q1 fiscal 2026, that segment posted just $139 million in operating profit, down from $338 million a year earlier. When that margin starts expanding again, it will signal that the revenue recovery is translating into real earnings power. That's the inflection point.
I love that. One number that tells the whole story. All right, let's close this out with a quote that hits home for any company built on feeding the world. This one comes from M.S. Swaminathan, the father of India's Green Revolution.
If agriculture goes wrong, nothing else will have a chance to go right.
That's about as clean a thesis for Deere's long-term relevance as you'll ever hear. Agriculture is the backbone, and Deere is building the nervous system on top of it.
Poetic for a tractor company, Hudson.
Hey, even tractors deserve a good metaphor. That's our deep dive on Deere Company, ticker DE, episode 123.
Facts, not opinions, you decide.
This is Charged Alpha, the S&P 500 stock encyclopedia.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.